I am so angry right now I could spit. And yeah, that's not normally how I open these videos. This is the Financial Freedom Show, and I am Rob Berger, and I'm really angry with Vanguard right now. And if you're a longtime viewer, you know that I'm a big Vanguard fan. I've owned Vanguard funds forever. But they did something recently that really hurt the regular small-time investor like you and me. And they actually hurt the small investor in favor of institutional clients. And frankly, I think it's inexcusable. The good news for us is it presents us with a learning experience. We might as well learn something from the pain. And I think it's really important. So what I'm going to do in this video is walk through the concept, and it has to do with investing in mutual funds inside a taxable account. I'm going to walk through what the issue is. I'm going to tell you what happened at Vanguard and what the consequences were for some investors. Then I'm going to show you why I think it could happen again in the future and what we might do about it. So let's get right into it. The issue has to do with the fact that mutual funds can distribute short-term and long-term capital gains, even if you never sell any shares. Now, we know that a stock, ETF or mutual fund typically pays some amount of yield, some amount of dividends. And if you hold that in a taxable account, you'll pay taxes on that each year, potentially. They typically are long-term capital gains, and they're typically relatively small, 1 or 2%, certainly for an index fund like an S&P 500 or total stock market. So these kinds of funds are still reasonably tax efficient. But however, we have to bear in mind that some of them do distribute capital gains, and it can be a real surprise. Let me show you on the screen. We're looking at Morningstar, and we'll just use Vanguard's Total Stock Market Mutual Fund. It's VTSAX. And I'm going to show you how we can see what this fund has distributed over the past few years. So we want to go to this Performance tab right here, and it shows us the returns. But what we want to click on is this Distributions tab. And it shows us the distributions, in this case going back to 2019. And the first column shows us what's called the net asset value. That's the net asset value of what the fund owns on a per share basis. Income, in this case, refers to dividends, and we expect those, and that's fine. It's a relatively small amount. And then here we see short-term capital gains and long-term capital gains, and you see that they're all zero. This fund has not distributed capital gains to shareholders, at least since 2019, and that's good news. So we look at this fund and we say, wonderful, it's tax efficient. Yeah, we've got some dividends we pay taxes on, but no long-term or short-term capital gains, so that's great. Well, it is good, but it turns out that not all funds are created equal. So let's take a look at another fund. This one is ticker VITFX. I'm guessing you've probably never heard of it. It's a target date retirement fund, but it's an institutional class of shares that you and I think most of us probably couldn't afford to invest in. And we'll talk about it in more detail, but let's just quickly look at performance. And we go to the distributions, and we'll see, look, this fund actually distributes some short and long-term capital gains. We see in 2021, they distributed both, plus income. Now, so if you held this in a taxable account, you would be paying taxes on these short and long-term capital gains. That's the bad news. The good news, I suppose, is that they're relatively small. I mean, this is just, 3.5 cents. This is 14 cents on a per share basis of over almost $32. And when we look down at the distributions over the last few years, they're really pretty minor. And so one could certainly understand why someone might invest in a fund like this if you had the money to meet their minimum requirements in a taxable account, not the most tax inefficient type of investment. And I know plenty of people that invest in not this fund, but other target date retirement funds inside a taxable account. Now, so what's the problem? You say, Rob, okay, it's maybe not the most tax efficient, but no big deal. Here's the problem. That fund we just looked at, until the end of 2020, required $100 million to invest in it. So that's probably not the kind of fund you and I are going to invest in, but you can think about employers with large 401ks and other institutional investors. They might use that, maybe inside a retirement account, for example. Fine. And they get a slightly lower expense ratio. You say, well, how much lower? Well, it's actually only 5 basis points. It goes from the 14 basis points you and I would pay down to 9. But still, hey, I'll save any penny I can. And if I had access to that fund, I'd certainly choose it over, the regular target date fund you and I have to invest in. But here's what Vanguard did. At the end of 2020, they lowered the minimum requirement to invest in that institutional class of funds from 100 million all the way down to 5 million. Now you might say, okay, Rob, well, I get it, but it doesn't really affect you and me. For the institutional investors, fine. Here's what happened. All of the institutional investors that now can qualify, they couldn't have qualified at the $100 million mark, but at 5 million they can. Guess what they did with their shares in the target date retirement fund that you and I might own? Well, they exited. They said, we're out of here. We're moving over to this cheaper fund. So what did Vanguard have to do? It had to sell a bunch of the investments inside the target date retirement fund that you or I might own in order to redeem these shares and send their institutional clients over to the fancy institutional share class that saves them 5 basis points. And that triggered short-term and long-term capital gains for the rest of us if you owned that target date retirement fund in a taxable account. You have to pay taxes on it. Now, I know you're thinking, Rob, okay, I kind of am following this, but how big a deal can this really be? I'm so glad you asked. Let's check it out. So here we're looking again. This is the institutional version, right? This is the fancy pants version that only costs 9 basis points. And yeah, it has some distributions. Not too bad, right? Well, let's move over to the version you and I would invest in. This is the standard old regular Vanguard Target Retirement 2035 Fund, VTTHX. We're going to look it up in Morningstar. And we do that with the little search box, VTTHX. Here it is. It's the exact same fund. It invests in the exact same thing. It's got a slightly higher expense ratio. Now, remember the distribution of the institutional share class. Well, what happened to the regular folk, the little guy, the folks like you and me when it comes to distributions? Look at this number right here. Over $4 in long-term capital gains on a share price of just under $24. That is massive. And you see it, wow, when we come down here. Those that owned this fund, when they distributed these capital gains, which was at the end of last year, December 29th, 2021, got walloped in taxes. And that is, without ever selling a single share, they're going to have to pay taxes on those distributions, including significant long-term capital gains. Now, that's what happened. Now, I know some of you might be saying, well, Rod, you probably shouldn't own a target date retirement fund in a taxable account anyway. I would generally agree with that. It holds bonds. Bonds pay interest. Interest gets taxed as ordinary income. Plus, the asset allocation is changing over time, and that's why you see, in part, some small amount of capital gains being distributed from year to year. Still, before 2021, it was still a reasonably tax-efficient investment, and certainly you could understand why someone wouldn't expect the train wreck of long-term capital gains distributions we saw at the end of 2021. Now, what was Vanguard's explanation for this? Well, I'm going to show you. This came up in a Wall Street Journal article by Jason Zweig. It's an excellent article. He explains what happened, including the minimum investments going from 100 million to 5 million. And here was Vanguard's answer. I don't know how well you can read it, so I'll read it for you. The spokeswoman, Carolyn Wegman, said that because the target retirement approach seeks to reduce risk over time by automatically trimming stock positions, quote, these funds are best served in a tax-deferred account. Well, while I can't disagree with that, that's not why the little guy, the small investor who happened to own target date retirement funds in a taxable account, got walloped last year. The reason they got walloped was because Vanguard lowered the minimum investment on their institutional share classes. That triggered a stampede out of the target date retirement fund that you and I might invest in into the institutional share class. And that's what triggered the significant long-term capital gains distributions of these funds at the end of last year. So here's why I'm really concerned. I want to go back to the screen. I want to show you an example of a different type of fund And we're going to start actually over here. This is Vanguard's plain vanilla S&P 500 index mutual fund. Many of you may own it in a taxable account, VFIAX. It's very inexpensive. It's 4 basis points. You need a $3,000 minimum investment. Here's the institutional fund version. It's 1 basis point, so it's only a 3 basis point difference. Now remember, the difference in the target date retirement funds we just looked at were only 5 basis points, right? The minimum investment for this fund is $5 billion. That's billion with a B. What would happen if they lower that one? What if they lower it to $1 billion? How about to $100 million? How about like the target date retirement fund, they lower it to $5 million? Would there be a stampede out of this S&P 500 index fund into this one, at least for the institutional class and wealthy family offices and other big-time investors, triggering significant capital gains distributions in this Vanguard S&P 500 index mutual fund? Now, before what happened last year with the target date funds, I would have said, oh, that's just silly. That's silly talk. It's not going to happen. Vanguard wouldn't do that to the small-time investor just to save its rich clients a couple of basis points. Well, it turns out now, we know, actually they would. They did that with the target date retirement fund. I don't know that they're going to do it with the S&P 500 fund or any of their other index funds that have lower cost institutional investors, but they've proven that they're willing to do it. You know, it's sort of fool me once, shame on you, fool me twice, shame on me. So in the past, I've talked about the fact that I just prefer mutual funds, even in taxable accounts, if they have a track record of not distributing short-term and long-term capital gains like many of the Vanguard index funds. But now, in light of what they did with this target date retirement fund, I'm no longer comfortable with that. Going forward, I will not buy Vanguard mutual funds inside a taxable account. I simply don't trust them to do right by the little investor in favor of institutional clients. Now, the question is, if you already own mutual funds in a taxable account, like I do, what can you do about it? Well, there actually is one possible answer, and I'm going to show it to you. And I'm going to preface this by saying this is not tax advice. I'm not a tax professional. I am simply showing you something from the Vanguard website, and here it is. According to Vanguard's website, and I'll go back to the top of this article, it's just common ETF questions. You can Google Vanguard common ETF questions, and you'll find this page. Here they say, conversions are allowed from both investor and admiral shares, those are mutual funds, and are tax-free if you own your mutual fund and ETF shares through Vanguard. And this is addressing the question, can I convert my conventional Vanguard mutual fund shares to Vanguard ETF shares? Right? Now, keep in mind, they say, that you can't convert ETF shares back to conventional shares. So if you convert from mutual funds to ETFs, you can do it tax-free according to Vanguard. But once you do it, you can't go back to mutual funds tax-free, so keep that in mind. The other thing they say is that if you have a brokerage account at Vanguard, there's no charge to convert conventional shares to ETFs. However, if you own Vanguard mutual fund shares through another broker, keep in mind that some brokers may not be able to convert fractional shares, which could result in a modest taxable gain for you. Other brokers may also charge a fee for a conversion. Contact your broker for more information. The key takeaway is you want to make sure you know the consequences of converting a mutual fund to an ETF, and we're talking specifically Vanguard, before you do it. I'm just showing you what Vanguard says about the process, but I can tell you I am looking into it now to convert mutual fund shares that I own into the ETF shares. Again, do I think it's likely that the same thing that happened with target date retirement funds will happen with an S&P 500 index fund or a total stock market mutual fund? I don't think so, but before last year, I would have thought the chances of this happening were zero. Now I believe the chances are something greater than zero, and I just don't trust Vanguard enough to leave it in their hands to decide my fate when it comes to the taxes on my investments in my taxable account. So you can tell I'm pretty upset with Vanguard right now, and I think you should be too. Again, I hope it didn't hurt you. I hope you didn't own those target date retirement funds in a taxable account, although I certainly couldn't fault you for doing so. They had a history of being reasonably tax efficient. But if you did, last year, you got walloped in taxes. So bear that in mind. If you have any questions, leave them below the video. I'll do my best to help you out any way I can. And until next time, remember, the best thing money can buy, probably not a Vanguard mutual fund in a taxable account, I'm sorry to say, but it is financial freedom.